So there's this new analysis making the rounds, and it lays out this fascinating and frankly pretty audacious path for MicroStrategy's stock to hit $5,000 a share. Now, I know that sounds absolutely wild, but the entire argument rests on a series of dominoes. And the very first one, well, it might be just about to be pushed over by the US Senate.
So that's really the big question we're tackling here. Is it actually possible for one piece of legislation to kick off a chain reaction that sends one single stock soaring that high? It seems almost unbelievable, but when you dig into it, the logic is surprisingly clear.
And the answer, according to this deep dive analysis, is a resounding yes. This isn't just wishful thinking. It's a structured thesis built on a clear cause and effect chain. And it all kicks off with that first legislative domino, a bill that is set to completely rewrite the rules for Bitcoin in the United States.
So first up, let's talk about the regulatory green light. The entire foundation of this $5,000 thesis isn't some new tech or a crazy market trend. Nope, it's a fundamental change in government policy, a regulatory shift that could finally unlock trillions of dollars in institutional capital that's been sitting on the sidelines.
The specific piece of legislation we're talking about is the Digital Asset Market Structure Bill. And its most critical job, the thing that changes everything, is that it would officially classify Bitcoin as a commodity, not a security. That one little change has absolutely massive downstream effects.
So why does that classification matter so much? Well, for years, the SEC, the Securities and Exchange Commission, has kind of been running the show with what you could call regulation by lawsuit. It's an enforcement-first approach, and it creates a ton of uncertainty for big money. This bill would move Bitcoin under the CFTC, the Commodity Futures Trading Commission, and their job is just to regulate market integrity. You're going from a regulator that wants to litigate the asset to one that just wants to make sure its trading is fair. It's a night and day difference.
And that right there is the institutional green light. Think about it. If you're a pension fund or a major bank, your biggest fear has always been some future SEC crackdown. If that threat gets legislated away, the single biggest barrier holding you back from getting into the Bitcoin market just evaporates.
This quote from the analysis just sums it up perfectly. The bill doesn't just lower the risk, it effectively illegalizes the fear of a government ban. It makes that worst-case scenario structurally impossible. For investors, this transforms MicroStrategy from a speculative bet into a compliant, fully regulated way to get Bitcoin exposure.
Now for the second domino, which the source calls the S&P 500 cheat code, because that very same Senate bill has a provision that fixes a huge kind of archaic accounting problem, a problem that has basically single-handedly kept MicroStrategy out of the S&P 500 index.
Okay, check out how backwards this was. Under the old rules, if MicroStrategy bought Bitcoin at 40 grand and it rocketed up to 70 grand, you know how much of that gain they could report? Zero. Not a dollar. But if the price dropped to 35 grand, they were forced to report that loss. See the problem? They could only ever report the risk, never the reward. And on paper, it made their profits look terrible.
This bill helps usher in what's called fair value accounting. And this is a total game changer. Now, in that same scenario, when Bitcoin hits $70,000, they get to report that $30,000 gain. All of a sudden, billions of dollars in previously invisible profits just materialize on their balance sheet. It completely transforms their profitability metrics practically overnight.
And the direct result of that is simple. The main technical reason the S&P 500 committee had for keeping MicroStrategy out of the index is gone. Poof, that key requirement for sustained, reported profitability can finally be met.
So what happens when a company actually gets into the S&P 500? It's huge. It's not like these funds can choose to buy it. We're talking about the giants, Vanguard, BlackRock, State Street. They are legally mandated to buy the stock to match their index weighting. It's automatic, it's not negotiable, and it creates this enormous foundational floor of buying pressure that just wasn't there before.
Okay, so this all sets the stage for the climax of the whole thesis. You have regulatory clarity slamming into S&P 500 index inclusion. And when these two things happen at the same time, they create this powerful collision of two very different and very unstoppable market forces.
The source calls this the flywheel effect, and it's pretty clever. So with the regulatory risk gone, MicroStrategy's credit rating gets better. That means they can borrow money at lower interest rates. What do they do with that cheap debt? They buy more Bitcoin, of course, which then drives the stock price even higher because of the leverage. It's a self-reinforcing upward cycle.
And here's the other kicker. This whole process structurally destroys the #1 argument against the company. The entire bet from the short sellers was basically that a regulatory crackdown was coming that would force MicroStrategy to sell its Bitcoin. With this bill, that bet is completely wiped off the table. Their whole reason for being short is gone.
And this is what creates the double squeeze. It's incredible. On one side, you've got the short sellers. They are now panic buyers. They don't care about the price. They just have to buy shares to close their positions and stop the bleeding. Then on the other side, you have the S&P 500 index funds. They are mandatory buyers. They are legally required to buy the stock.
So what's the result? You have desperate, panicked buyers smashing into legally required, systematic buyers at the exact same time. The available supply of shares on the market simply cannot handle that kind of overwhelming, sudden demand coming from two totally different directions. It's a classic demand shock.
Okay, so that's the whole chain of events. But how do we actually get to that $5,000 number? Let's take a quick look at the final math and see exactly how it all adds up.
It all starts with the first big assumption. With the regulatory cloud gone for the whole crypto space, all that institutional capital we talked about finally flows in, pushing the price of Bitcoin itself up to a new high of $200,000.
The second assumption is just based on history. If you look at the data, investors have consistently been willing to pay a premium for MicroStrategy stock over its actual Bitcoin holdings. This analysis uses a multiplier of 2.5 times its net asset value to account for that unique levered structure.
So the equation becomes pretty simple. You take the company's new, much larger net asset value, which is calculated with Bitcoin at 200,000, and you multiply that by the historical premium of 2.5.
And when you run those numbers, the implied share price lands right around that $5,000 mark. It's a clean, simple logic that flows directly from that very first domino, the Senate bill, all the way to this final valuation.
The analysis wraps it all up with this really powerful idea. It frames this whole thing as a fundamental power shift. For years, Wall Street regulators created uncertainty and held things back. But now, it might be congressional legislators who provide the clarity to set it free.
But at the end of the day, it all comes back to one critical point. This entire incredible thesis we've just explored, the regulatory clarity, the S&P inclusion, that wild double squeeze, it all hinges on this one single bill actually becoming law. Which of course leaves us with the ultimate question. What happens to this entire bullish case if that first most important domino never falls?